I'm Tom Dalton. This is the second video in a two-part series explaining substantial economic effect and partnership allocations of profit and losses. In the first video, we explained the basic requirements of substantial economic effect. In this video, let's look at an exception to those requirements. As we saw in the first video, the big three requirements required for partnership allocations to have economic effect are 1. The partnership must maintain economic capital accounts for each of the partners. 2. Each partner's legal claim on the partnership assets is determined by their economic capital accounts. And 3. Any partner with a negative economic capital account when the partnership is liquidated must restore the capital account to zero by contributing property or cash to the partnership. Okay, that sounds fair. The Treasury is only asking that tax allocations of profits and losses have economic substance, and that the allocations be more than just a scam to save taxes. Why would anyone object to that? Let's look at a simple example of why a limited partner or LLC member might object to the third condition, the requirement to pay back a negative economic capital account. Let's say two people form a partnership. One as a general partner and one is a limited partner. The general partner contributes $10,000 for a 10% interest, and the limited partner contributes $90,000 for a 90% interest. The tax balance sheet and the 704B balance sheet are still the same, but for the purposes of substantial economic effect, only the 704B balance sheet is relevant. So from now on, let's focus on that one. Next, the partnership borrows $900,000 and uses the loan and the existing cash to buy land for $1 million. But then something goes wrong. The land declines to a value of $100,000. On a fair market value standard, the balance sheet would look like this. The 704B balance sheet has not changed yet, because only certain revaluation events specified in the Treasury regulations cause the 704B balance sheet to change. After some discussion, though, the partners decide to end the partnership. Dissolution of the partnership causes the 704B balance sheet to revalue the land and the capital accounts to fair market value. Now the 704B balance sheet looks like the fair market value balance sheet. Well, guess what? The requirement to pay back a negative economic capital account kicks in, and the limited partner is legally required to pay the partnership $720,000 as per the partnership agreement. Imagine the limited partner's shock. She thought the most she could lose was her $90,000 initial investment. So the limited partner does not want to agree to the third condition of the big three. She does not want to be responsible for paying back a negative economic capital account. This requirement could defeat the purpose of limited liability. So the Treasury regulations give the partners a way out of this dilemma. There is a light at the end of the tunnel. A partner does not have to agree to the third condition, restoring a negative economic capital account, if, first, the partnership agreement stipulates that the partner will never receive an allocation of losses that will drive the economic capital account negative. And second, the partnership agreement has a qualified income offset provision. A qualified income offset provision simply requires the partnership to allocate profits to this partner in the event something goes wrong, such as a partnership distribution, that inadvertently drives the partner's economic capital account below zero. So, if an inadvertent distribution drives the partner's 704B capital account below zero, as soon as possible, the partnership will allocate enough profit to the partner to bring the capital account back to zero. What would happen in our earlier example with the limited partner if she refused to agree to restore a negative economic capital account? The partnership agreement must include a qualified income offset. and her losses are now limited to her $90,000 economic capital account. The remaining losses are allocated to the general partner, who did agree to restore the negative capital account. What happens to the loss if the general partner also refuses to agree to restore a negative economic capital account? Or more likely, this is an LLC, and no LLC member agrees to restore a negative economic capital account. Who gets the losses? Well, we go back to the very beginning of the substantial economic effect regulations, which tell us that if the partnership or LLC agreement doesn't have substantial economic effect or is silent on how profits and losses are to be allocated, then profits and losses will be allocated according to the partner's interests in the partnership. And it is that ambiguity that we are trying to avoid. So a good attorney drafting the agreement will make sure that doesn't happen. Okay, we solved that problem. The partnership stays on the right side of the substantial economic effect requirements. The IRS will respect our profit and loss allocations, and limited partners and LLC members can avoid the negative capital account restoration requirement. Except that's no fun. The limited partners and LLC members want to deduct tax losses, and those tax losses might drive their economic capital accounts below zero. That brings us to another useful exception. To the extent partnership losses and negative capital accounts can be restored through a thing called minimum gain, the losses can drive the economic capital accounts below zero and still qualify for substantial economic effect, even though that partner has not agreed to a negative capital account restoration requirement. What happens is the minimum gain compensates for the negative capital account and, in effect, substitutes for the negative capital account restoration requirement. The partner doesn't actually recognize the minimum gain unless the property is lost in foreclosure. The minimum gain just lurks in the background as a potential recognized gain. So what is this minimum gain and how do I get some? Simply put, minimum gain is the economic gain that results if a person walks away from a non-recourse debt and allows the property securing that debt to be repossessed. For example, suppose I own a building that was purchased with a $100,000 non-recourse debt, and the economic basis of the building, as shown on the 704B balance sheet, is $90,000. Then the economic gain I have, if there is a foreclosure, is $10,000, which is $100,000 debt relief minus the 704B basis in the building. $10,000 is the absolute minimum amount of economic gain that I will experience if the bank forecloses on the loan and I walk away. In a partnership, if the $10,000 of economic gain is allocated to me by the partnership agreement, then the gain, in the event of a foreclosure, will increase my economic capital account by $10,000. This allows me to actually take a share of partnership losses that will drive my capital account to a negative $10,000, and I will still be covered by the $10,000 of potential minimum gain. Think of minimum gain as a substitute for the requirement to restore a negative economic capital account under the substantial economic effect rules. Let's look at this within a partnership. In this partnership, I am a limited partner. I have not agreed to a negative capital account restoration requirement. So, the partnership should not allocate any losses to me. If it did, that would drive my capital account below zero. But let's say that the partnership agreement allocates 100% of the depreciation expense to me. In our example, let's assume that there are no revenues and that the partnership's only expense is depreciation on the building. Let's say that the economic depreciation expense is $10,000. So, the depreciation expense creates a $10,000 loss, and if that loss is allocated to me, it would drive my economic capital account to a negative $10,000. But the depreciation expense also creates $10,000 of minimum gain, assuming that the amount of the liability hasn't changed. The $100,000 non-recourse debt minus the $90,000 economic basis in the building creates $10,000 of minimum gain. If the partnership agreement allocates the minimum gain to me, it is also allowed to allocate the $10,000 loss to me, making my economic capital account a negative $10,000. Deductions that qualify for this treatment are called minimum gain deductions. The deductions must be financed by non-recourse debt. In this example, the building was financed by non-recourse debt, so the associated depreciation expense is financed by non-recourse debt. This makes the depreciation expense a minimum gain deduction. Even though I have not agreed to a negative capital account restoration requirement, if the partnership defaults on the mortgage and the property is repossessed, the partnership will have a minimum of $10,000 economic gain. That gain will be allocated to me and my capital account will be restored to zero. As you can see, this is a substitute for the negative capital account restoration requirement. Notice that all of this is based on economic balance sheets and allocations. It is not based on tax balance sheets or allocations. So how does it connect with the profits and losses that show up on the partnership tax return? It is connected because the substantial economic effect requirements stipulate that tax allocations must be reasonably consistent with these economic allocations. In our example, because the 704B economic basis in the building is the same as the tax basis in the building, the depreciation expense will probably be the same. Therefore, the loss for tax purposes will be the same as the loss for economic purposes. If the loss for tax and economic purposes are equal, everything matches up. But what if the economic basis, in other words, the fair market value, is different from the tax basis? That could happen if a partner contributed the building to the partnership when the fair market value is different from the tax basis. In that case, the gain would be different if the building is sold, and the annual depreciation expense would also be different. We'll sidestep that question for now and handle it in another couple of videos about IRC Section 704C. The minimum gain allocated to a partner is also used in allocating a portion of non-recourse debt to a partner at the end of the year. But we'll look at non-recourse debt allocations in another video. Another thing to point out is that the 704B balance sheet is not exactly identical to a fair market value balance sheet. They start out the same, as shown here, but actual fair market value changes by the minute. The building fair market value could rise to $110,000, and then to $120,000, and then to $130,000. And the 704B balance sheet remains the same. The 704B balance sheet does not change until one of the events listed in the Treasury regulations allow the partnership to revalue the balance sheet assets to current market value. Those specified events usually involve a change of ownership in the partnership, and other than those events, the 704B balance sheet assets stay at their original value except for economic depreciation expense. The tax balance sheet is usually different than both the 704B balance sheet and the true fair market value balance sheet. The tax balance sheet is not involved in the economic effect calculations. Thanks for watching. If you have any questions or comments, feel free to send me an email. If you like this video and would like to see more, feel free to subscribe.